is periodic portfolio rebalancing important, and what strategies should investors use to maintain an optimal risk reward ratio? If you can take us through that.
So I think, while most of us focus on risk from the prism that, can we lose a certain amount of money due to the volatility and the vagaries of the markets, I think the bigger risk is the opportunity cost of not investing in markets. I mean, so when we talk about risk reward, I think we also tend to kind of overlook that aspect, that what is not invested possibly has got a far greater chance of not able to meet our financial obligations. So that is one key aspect that we have to consider. Now, the second key aspect is having invested into markets or into instruments which move up and down. It is important not to put all our eggs in one basket. I think it's very clear that we need to have a diversified asset allocation approach. Uh, More importantly, it is like having a thali, as a meal. You don't want to be only in carbohydrates. You don't want to be only in proteins. You don't want to have only sweet, but you need to have a balanced approach, which is basically that you need to have a reasonable amount of allocation to products like equities, and even within equities, you need to have, say, your diversified funds, which are all-weather funds, which are not focused on a particular theme or which are not focused on a particular sector, but go across. So that should be your bulk of your allocation. And then you need to top it up basis your risk profile and also understanding where the market and the business cycle of various sectors is moving on. And that is where you've got thematic funds, sectoral funds, etc., which are like, the side dishes that can accompany the main meal, right? The third aspect is, do we just let it run through the course of its up and down, or do we need to balance it with something which is not what we call in financial terms correlated with the main asset class? So you want to buy into asset classes which don't move along the same way that the rest of the asset classes move. So, for example, gold, for example, is a reasonable counter-cyclical or a less correlated asset class compared to, say, equities. A certain aspect of debt is reasonably less correlated to that of equities. And therefore, you want to have an allocation not to maximize your wealth at any point of time, but more to ensure that it's a very balanced kind of an approach. The fourth thing, as you rightly said, is to timely rebalance, right? Now, there is no preset frequency that you have to rebalance every 3 months, 6 months, 1 year. It can vary from person to person, and more importantly, on the tolerance of the volatility that they can afford to tolerate or withstand, right? But generally, I would think that it's a good practice always to have an annual review of the portfolio to see whether the tolerance bands have kind of got breached, in which case it's always better to kind of get it back into control. It's like saying doing an annual checkup, right? It is not to say that one should get obsessed with doing a checkup every 3 months, 6 months, but to do a broad checkup so that we get to know which are the areas that we are deficient in, which are the areas that we want to further focus on, and how close are we to our end goals of fitness of our financial well-being. And therefore, I think annual checkup is a reasonably good point. The second, and sometimes a rarer possibility, is where markets have moved up significantly or have fallen down significantly. So, when you see that, for example, markets have fallen 25, 30, 40%. And because of that, it may not necessarily coincide with your annual kind of a point in time where you're doing the portfolio review. But if you think that there is an overwhelming either exuberance or a massive panic, that is also a time where it makes sense to take a relook as to where you are currently positioned and to take it. The last thing is, I think in all our journeys, we need to have a peaceful night's sleep. And that needs to be a very good barometer to see, are we overexposed to one category or not? So if we are forever going to check what Dow Jones is up to in the night, possibly we are overexposed to the equity asset class, and vice versa. So I think there is no one size fits all, but it is more a function of your own calling in terms of the risk tolerance that you can potentially take. But yeah, these would be what I would suggest, which can help a long way in terms of maintaining financial fitness.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।